When you think of investing, bonds often come to mind as the safe choice. Many believe that buying bonds is like tucking your money under a mattress, nice and secure. But here's the shocking truth. Over the last year, the bond market lost 13%, its worst performance since the 1970s. That's right, bonds aren't as safe as you might think. A recent study showed that more than 50% of investors don't understand the risks associated with bonds. They think that as long as they hold them until maturity, they'll be fine. But what if you need to sell? What if inflation outpaces your returns? In this video, we'll uncover the hidden dangers in bond investing that no one talks about. From interest rate traps to the sneaky effects of inflation, we'll explore why relying solely on bonds could put your financial future at risk. Are you ready to learn about these pitfalls? Let's dive into the world of bonds and reveal the shocking truths that could change the way you invest. Chapter 1. The safe haven illusion. Bonds aren't what you think. Bonds have long been considered the go-to, safe investment. They're what you buy when you want stability, right? But here's the thing. Times have changed. Bonds aren't as secure as they once were. A lot of people still think of bonds as this invincible shield against market volatility. That's a mistake. Let's start with a hard truth. Today's bond market is way more volatile than most investors realize. For example, the US bond market lost 13% in 2022, which was its worst performance since the 1970s. That's right, bonds, which people assume are rock solid, had one of their worst years ever. It's a reminder that nothing is risk-free. A lot of this comes from the idea that bonds are supposed to be the safe bet in a portfolio. But when interest rates rise, like they have recently, bond prices fall. This is a fundamental rule that many new investors don't understand. They see bonds as steady, but when interest rates shift, their bond portfolios can lose value fast. Warren Buffett himself has said, bonds are not the place to be these days. Instead of putting all your faith in bonds, consider diversification. Yes, bonds can still play a role, but only if you balance them with other assets like stocks, real estate, or commodities. The more you spread your risk, the less likely you are to get caught off guard by a bond market slump. Chapter 2. Interest rate trap. How the Fed's moves could sink you. Interest rates. They're like the invisible hand guiding the bond market. The Fed raises rates, and suddenly, your safe bond investment doesn't look so great. Why? Because when rates go up, the value of existing bonds goes down. Here's why. Newer bonds pay more interest, so why would anyone want your older, lower-paying bond? In 2022, the Federal Reserve hiked interest rates 7 times, leading to a sharp decline in bond prices. This caught a lot of bondholders off guard, and many saw their portfolios shrink almost overnight. This is the interest rate trap that people don't talk about enough. A lot of investors assume that they can hold their bonds until maturity and avoid losses. That's partially true, but what happens if you need to sell your bonds early? In a rising interest rate environment, you could be selling at a big loss. Even if you're holding bonds until maturity, inflation can eat away at the real return of your investment. More on that in the next chapter. The key strategy here is to keep an eye on the Fed's moves. Understanding how the central bank's policies impact bonds can help you make smarter decisions. You might want to stick to shorter duration bonds in a rising rate environment. These bonds are less sensitive to interest rate changes, so they won't lose as much value if rates keep climbing. Another option is to invest in floating rate bonds, which adjust their interest payments based on market conditions, protecting you from rising rates. Chapter 3. Inflation's silent attack. How bonds lose their power. Inflation is like a hidden tax on your bond returns. If inflation is higher than the interest your bond pays, you're losing money in real terms. This is a danger that a lot of bond investors overlook. For example, in 2021, US inflation hit 7%, the highest in decades, and most bond yields couldn't keep up. Imagine holding a bond that pays 2% interest while inflation is 7%. You're actually losing 5% of purchasing power. In the past, bonds were seen as a hedge against inflation. But those days are gone, especially with today's low interest environment. Many government bonds yield less than inflation. According to a 2021 report, more than $17 trillion worth of bonds globally had negative real yields, meaning inflation outpaced their interest. Investors holding these bonds are essentially paying for the privilege of holding them. Crazy, right? So, how do you protect yourself? One option is inflation-protected bonds like Treasury inflation-protected securities, TIPS. These bonds adjust their principal based on inflation rates, so your returns are more likely to keep up with rising prices. Another strategy is to include real assets in your portfolio, things like real estate or commodities, which often rise in value along with inflation. In conclusion, bonds are not immune to the changing economic landscape. Whether it's interest rate shifts or inflation, the risks are real. Diversification, floating rate bonds, and inflation-protected securities can all help shield you from these hidden dangers. If you found this information valuable, don't forget to subscribe to our channel for more insights on investing and financial strategies. Chapter 4. The Liquidity Mirage. What happens when you can't cash out? Let's talk about liquidity. It's one of those things investors take for granted, until they can't sell their bonds. Bonds, especially corporate ones, aren't always as easy to sell as you think. Sure, US Treasuries are super liquid, but that's not true for every type of bond. In fact, less than 1% of bonds trade daily on the secondary market. That's right. If you need cash fast, there's no guarantee someone will be waiting to buy your bond. This became painfully clear during the 2008 financial crisis when bondholders struggled to sell their positions. In a crisis, everyone wants to sell, and liquidity can dry up fast. The same thing happened in 2020 when the pandemic hit. Investors rushed for the exits, but many bondholders were stuck holding the bag. What can you do to avoid this liquidity trap? First, understand what you're buying. Corporate bonds, for example, are riskier and less liquid than government bonds. If you're investing in them, know the risks. One way to improve liquidity is to stick with highly rated bonds like investment-grade corporate bonds. These are usually easier to sell than junk bonds. Another option is to use bond ETFs instead of individual bonds. Bond ETFs trade like stocks, so they're much more liquid. You can buy or sell them quickly without worrying about whether there's a buyer for each specific bond. It's a smart strategy if you want bond exposure without sacrificing liquidity. Chapter 5. Default risks aren't just for stocks. The real bond bust. Most people think default risk is something that only applies to stocks or risky companies. But bonds can default, too, and when they do, the losses can be massive. Take Argentina, for example. It has defaulted on its debt 9 times in its history, most recently in 2020. Investors holding Argentinian bonds were left with pennies on the dollar. Even in the US, corporate bond defaults are more common than people think. In 2020, during the COVID-19 pandemic, the default rate on high-yield bonds, aka junk bonds, soared to 6.2%, according to Moody's. This means that more than 6% of companies couldn't pay back their bondholders. So, how can you protect yourself from this kind of risk? First, understand the credit rating of the bonds you're buying. Bonds are rated by agencies like Moody's, Standard & Poor's, and Fitch. Investment-grade bonds, rated BBB or higher, are less likely to default, while high-yield or junk bonds carry more risk. A good strategy is to diversify across bond types. Don't put all your money into one company's bonds or even one sector. Spread your investments across different industries, and consider including government bonds in the mix. US Treasuries have virtually zero default risk, so they can act as a safety net. You can also use bond mutual funds or ETFs to automatically diversify. These funds hold dozens or even hundreds of different bonds, so even if one company defaults, the overall impact is smaller. This strategy reduces your exposure to any single bond's default risk. If you enjoyed this deep dive into bond investing, make sure to subscribe to our channel. We'll keep bringing you insights to help you navigate the financial landscape.